The $10 trillion dirt lie. Who is really buying up America's farmland? The $10 trillion lie, 100 words. The number looks harmless in a pension slide, $10 trillion. But that figure sits under your dinner plate. If farmland prices wobble, it won't be a paper loss. It'll be shelves, rents, and sovereignty. Here's the twist. The buyers shaping those acres don't live on county roads, and their names aren't on the mailboxes. The land has been sliced, collateralized, and traded far from the fields it feeds. If the land's ours, why does your grocery bill depend on a spreadsheet in New York? Let's test the story everyone repeats against the first hard evidence, the numbers that don't come from the soil. Financialized dirt, proof of the lie. Start with what this looks like in a kitchen, not a quarterly deck. A landlord, owned by a fund you'll never meet, emails a market adjustment. Rent jumps $42,000 across 1,200 acres. The term shrinks from 5 years to 2. The bank, seeing the shorter lease, trims the operating line by $80,000. Jake cancels a $19,500 cover crop plan and pushes fertilizer to chase yield. His daughter asks if they're still going to the county fair. He says, "We'll see," and means probably not. Now zoom out to how you can buy into that moment without touching dirt. You can log into a brokerage account and in seconds own shares of a farmland REIT. It looks simple. The trust collects rent from farmers, pays you a dividend, and touts diversification. Almonds in California, corn in Illinois, berries in Florida. Earnings calls talk about portfolio composition and weighted average lease terms. You almost never hear about aquifer drawdowns, salt buildup, or the cost of a fallow year. The story sells stability. The product sells liquidity. Here's what that liquidity means for real people. A private fund raises $350 million from pensions and insurers. It buys 18,000 acres across 3 states and lifts market rents by 8 to 12% to hit a target dividend. That's $24 to $48 more per acre, $28,800 to $57,600 per year on a 1,200-acre lease. The operator cuts a hired hand's hours, skips a $6,200 pump overhaul, and prays the motor survives July. A crowdfunding portal pitches "Own a slice of America" for $10,000. The slice is a claim on someone else's season. When redemptions hit, parcels get listed. Comps fall. A local bank revalues collateral and shaves $50,000 off another operator's line. The pitch is access. The consequence is pressure. Now look at the numbers that make distance profitable. From the 1990s through the early 2020s, private farmland indices reported double-digit total returns on average. In several states, land values jumped 30 to 40% in under 3 years during the last cycle, while per-acre operating profits barely moved. Rents climbed faster than yields. The appreciation curve, not the harvest, carried the returns. That's the decoupling, price set by liquidity, not productivity. Here's how the flywheel turns. A fund acquires 10,000 acres across 3 states. Rising comparable sales lift the appraised net asset value. With a higher NAV, the fund borrows more on the portfolio, then buys more land. Each purchase becomes the next comp. The cycle repeats: higher marks, cheaper credit, larger balance sheet, more acquisitions. Meanwhile, tenant operators face steeper rent escalators to support those marks. The leverage sits on spreadsheets, the risk sits on tractors. Slogans smooth over the friction. They're not making more land lands well in a conference room, but arable land is shrinking in key basins, water costs are rising, and climate variance pushes yields off the model. The scarcity that's supposed to guarantee value is the same scarcity that erodes productivity. If price outruns what the ground can grow, the spread is speculation. Evidence of the transformation shows up in language. In filings and decks, fields become units, assets, stabilized rent streams. Soil becomes a risk factor, not an ecosystem. Dividend targets are clear, soil organic matter is incidental. The logic is familiar. In real estate, tenants pay monthly. In farmland, tenants pay by season. Either way, the cash flow is securitized. Trace the forms. Public REITs file quarterly. You can watch their acquisitions hopscotch between counties. Private funds disclose less but announce platform expansions into new regions. Crowdfunding vehicles spin up LLCs for each parcel and promise a secondary market later. ETFs build indices to track the category. Every layer boosts exposure without adding one agronomist to a lease review. What happens on the ground when exposure scales? Lease terms trend shorter, with ratchets tied to reference prices rather than field conditions. Some landlords benchmark rent to corn futures or regional caps rather than local moisture and inputs. In a drought year, the spreadsheet expects its due. Miss a payment and the lease can switch to a larger operator with the volume and equipment to meet aggressive yield targets. The system enforces the line item: rent first, resilience later. Look at water briefly, because it anchors the returns even when investors ignore it. In the High Plains, parts of the Ogallala support roughly a third of U.S. crop and animal production. Drawdowns there intersect with high-rent crops, corn for feed, thirsty nuts and specialty fruit in the West, kept on life support by irrigation pivots financed as capital improvements. Water rights ride with the deed, and the deed rides in a portfolio. The collateral is liquid because the aquifer is. Back to the balance sheet. Managers summarize risk as rate sensitivity. When borrowing costs were near zero, Farmland's perceived stability made debt look harmless. As rates rose, spreads compressed, and funds leaned harder on rent increases and asset sales. The pressure didn't show up on investor dashboards first. It showed up in operator margins, input deferrals, and delayed maintenance. You can defer a cover crop 1 year. You can't defer a debt covenant. Regulators aren't built for this market. Banking rules hit loans, real estate exemptions shield funds. There's no standardized reserve requirement for farmland portfolios or ratings for agricultural rent-backed products. Legal teams call farms infrastructure to thread statutes meant for roads and bridges. The capital moves faster than the oversight. Does the capital help? Sometimes. New irrigation, cold storage, or better roads can reduce loss and expand market access, but the upgrades are justified by return metrics first, and they're reversible. If commodity prices dip, the parcel pivots to solar, logistics, or land banking. The soil inherits the cycle, the community inherits the vacancy. So the proof of the lie is this: value is marketed as tied to the earth, but price is driven by tradable claims on the earth. Distance creates a buffer between the person who eats risk and the person who books yield. That buffer holds until weather, rates, or policy shove through it. Meanwhile, in kitchens, the pass-through is quiet. Rent pressure pushes crop choices toward water-heavy, price-chasing rotations. Volatility moves upstream into contracts and downstream into prices. When paper risk lands anywhere, it lands on a table where someone is deciding between milk and fuel. This is the moment everything changes. The chart looks safe until the basin runs dry, the lease resets, or the line of credit tightens. The system doesn't fall on Wall Street first. It bends a fence post, it closes a school, and then it shows up in your receipt. The origin: how dirt became a ticker. To understand how a field turned into a financial product, we need to go back to two hangovers: debt in the 1980s and doubt in 2008. Both moments reshaped who held the deed, why they held it, and what they expected from the ground beneath it. The first cleared the table for consolidation. The second set the terms for securitization. Between them, policy, tax code, and a culture shift turned soil into a spreadsheet. Start in the 1980s. Interest rates spiked. Commodity prices slumped. Farm debt that had looked manageable at 7% started resetting toward 15% and beyond. Land values fell hard. Families who had grown corn on quarter sections for 3 generations watched auctions draw strangers. Local banks took losses. Equipment got repossessed. The people who could buy were the ones with cash or access to it: regional operators, insurers, and early real estate vehicles. Foreclosure sales weren't just transactions, they were transfers of power. The land didn't move, but the command over it did. In the aftermath, a quiet consolidation took root. Fewer operators managed more acres. The agronomy stayed, the ownership changed. Debt discipline hardened into a mantra: never get over your skis. But the lesson didn't stick in the same way for everyone. Capital further from the weather remembered something else. Land could be acquired at scale when credit conditions turned and sold when they eased. That's not a farm strategy, that's a cycle strategy. Jump to the 2000s and the years after the housing crash. In a world burned by mortgage derivatives, farmland got pitched as the anti-bubble. It produced something people needed: It wasn't correlated to tech indices. The headlines about defaults were in Phoenix and Miami, not in county seats. A new investor class noticed. Pension funds needed steady returns to match obligations. Insurers needed duration. Endowments wanted inflation hedges. Farmland checked boxes in every deck. Scarcity narrative, visible collateral, long horizons. Policy greased the track. Real estate investment trusts had been around for decades, but pieces of the tax code and regulatory guidance clarified that agricultural real estate could qualify. Pair that with like-kind exchanges under Section 1031, and land could roll from one parcel into another without a recognized capital gain, so long as you stayed within the property family. Meanwhile, infrastructure language drifted. If a pipeline counted as infrastructure, why not an irrigation mainline? If a bridge's cash flows could be securitized, why not a long-term orchard lease? Aga's infrastructure entered memos and legal arguments. It wasn't about crops, it was about creating a compliant wrapper. Then came the low-rate era. For a decade, money was cheap. You couldn't get 5% on a safe bond, but you could show 5 to 7% on a farm lease plus appreciation, with volatility charts that looked flat compared to equities. The commodities supercycle flared around 2012, reinforcing the pitch. Grain prices surged, export demand looked durable, ethanol mandates locked in a demand floor, new funds launched with confidence. Securitized farmland didn't look speculative, it looked prudent. The culture followed the capital. Portfolio managers learned enough farm vocabulary to speak convincingly without getting mud on their boots. They hired acquisition teams to assemble multi-state portfolios and plugged agronomy into underwriting models as a tab: rainfall, soils, historical yields, next to cost of capital and tenant credit. Field variability flattened into risk scores. Yield meant two things at once: bushels and basis points. When the word holds two meanings, incentives choose one. Meanwhile, operating profit was reinterpreted. In an owner-operator model, yield variance and soil stewardship decisions were inseparable from wealth. In a landlord-tenant model optimized for securitization, those choices moved to the tenant's column while the owner secured the rent stream. That division made the next step logical: treat farm cash flows like other real estate, shorten lease terms to manage rate risk, embed escalators to protect returns, tie rents to external benchmarks to present a clean, predictable story to investors. You could see the scaffolding build in offering documents. REIT eligibility highlighted pass-through taxation and dividend requirements. Private placement memoranda described target IRRs supported by modest leverage and disciplined acquisition of undervalued acreage. 1031 exchange marketing promised a tax-efficient transition from apartments or industrial into mission-critical farmland. Infrastructure funds carved carve-outs: storage, water conveyance, on-farm energy. The legal architecture did more than permit ownership, it standardized it. Here's where low rates amplified belief. If you can borrow at 3% and lease at 5% with an appreciation tailwind, you look like a genius. Rising NAVs validated the thesis, boards approved more allocations. Consultants circulated cross-asset scatterplots with farmland in the low volatility, steady return quadrant. Articles praised land's resilience. Even regulators, wary after housing, didn't see the same red flags because the leverage was often at the fund level, not strapped to individual farmers in public view. But the conversion wasn't only financial, it was linguistic. In meetings, managers referred to purchases as programmatic acquisitions. They showed heat maps of exposure. They spoke about tenant mix and crop diversification strategy as if they were discussing malls and anchor stores. The business of feeding people was reframed as a business of renting ground to producers who survived the bid. The era didn't eliminate husbandry, it subordinated it to quarterly marks. What nobody saw clearly at first was the second asset bundled with the first: water. In many basins, the deed carries groundwater rights or surface rights sit in the same corporate structure. A fund that bought an orchard or a block of row crop land acquired the right to draw from aquifers or canals. In the high plains, that meant tapping a giant but declining savings account. In the West, that meant banking seniority in priority systems older than the funds themselves. Water became an unpriced hedge. If returns dipped, the value embedded in rights could backstop the thesis. That set up a quiet race to pump, pipe, or monetize scarcity. While capital discovered water, policy helped again. States stretched to define beneficial use, transfers, and storage. Municipalities wrote long-term water plans that opened doors for private partnerships, transfers, or leases of agricultural rights to cities. Some funds started marketing water optionality in their materials. Others kept it under the headline of resource security. Either way, the soil penciled because the water did. The spreadsheet didn't have to name it to rely on it. Internally, the pitch evolved after 2015. With spreads narrowing in traditional real estate, Farmland moved from alternative corner to a slide near the core allocation section. Advisors built model portfolios, 5% farmland exposure alongside timber, infrastructure, and private credit. The argument wasn't just return, it was correlation. Farmland's line moved differently than stocks, they said, so even a small slice smoothed the ride. Smoothing became a selling point as much as yield. At the same time, technology put a sheen on the story. Precision ag platforms promised data-driven farming. Funds showcased drone footage, NDVI maps, and dashboards translating hectares into heat maps. Sensors measured moisture, pivots logged cycles, tractors streamed telemetry. The data made the business feel modern and controllable. But who owned the data? Often not the person on the tractor. Contracts buried rights to aggregate and anonymize field-level intelligence, moving value upstream to platforms and owners. The field became an input generator for someone else's edge. The result was a mind shift that reached even cautious boards. If an asset can be measured, it can be modeled. If it can be modeled, it can be underwritten. If it can be underwritten, it can be scaled. Scale justified management fees. Fees justified headcount. Headcount justified more product. The feedback loop wasn't evil, it was efficient, but it was indifferent to the one variable no spreadsheet can fix: moisture in the right place at the right time. Meanwhile, the underlying agriculture kept cycling. Prices swung with weather and trade. Input costs rose and fell with energy and geopolitics. Farmers adapted, as they always do, but lease pressure changed the range of acceptable choices. When owners promised fixed returns to outside capital, tenants absorbed variance through tighter rotations, heavier irrigation, or higher-risk crops chasing price spikes. Those weren't just farm decisions, they were balance sheet decisions made at a distance. There was a final accelerant: stories. They're not making more land. Food is the new oil. Hard assets in uncertain times. These lines weren't true or false in a simple way. They were compact ways to convert fear into allocation. They turned weather into narrative and narrative into capital. The more they were repeated, the more they became the baseline for price, regardless of field conditions. That's how a patch of earth becomes a ticker. Belief finds structure, structure finds leverage, leverage finds a story. When rates climbed off the floor, the model didn't break. It adjusted. Managers extended lease escalators. They trimmed distributions to preserve liquidity. They sold non-core parcels. Some pivoted acreage to solar where interconnection allowed. Others packaged water assets for transfer or long-term leases to municipalities. Flexibility was a feature when the spreadsheet owned the deed, but that flexibility had an opposite face for communities. A pivot away from crops meant fewer seasonal jobs, fewer purchases at the co-op, fewer kids in the school. Balance sheet resilience didn't look like resilience in town. If this all sounds inevitable, it was. It was assembled step by step. A crisis that redistributed ownership, a tax code that rewarded rolling gains, rates that made debt feel painless, instruments that turned cash flows into dividends, a culture that accepted remote control over local necessities, and a hydrology that could be tapped without immediate consequence. Each piece made sense alone. Together, they made farmland behave like a financial product with a pantry attached. Meanwhile, under the fields, the quieter asset kept ticking down. Aquifers in stressed basins fell faster where rent targets met drought. Irrigation became a capital improvement to defend marks. Water tables didn't care about IRRs, they cared about withdrawals. And as scarcity deepened, the implicit value of water rights inside land portfolios rose, making the underlying temptation stronger. Pump now, justify later, transfer if you can, monetize if you must. Before we go underground and follow those rights through pipes and statutes, meet the people carrying the risk you don't see on an investor slide. The tenants whose names are on the checks, not the deeds. They're the ones who get the email that says the lease is being repriced to market. They're the ones who choose between paying rent and letting a field rest. They're the ones whose decisions define whether your grocery bill is calm this season or not. Farmers on the hook lives in the margin. Start with a Tuesday email. Subject line, lease adjustment, effective next season. Jake reads it at the kitchen table while his daughter finishes homework. 3 lines down, the number stings, rent up 12%, term shortened from 5 years to 2, benchmarked to a regional corn index that never heard of last summer's hail. He calls the property manager and gets a dashboard answer. It's just bringing you to market. Market doesn't know the name of his dog or the creek that stalled planting for 8 days. Market wants the check. The stakes land in small choices that don't look like drama until you run a season through them. Higher rent pulls fallow out of the rotation. Cover crops turn into maybe next year. Fertilizer rates creep up to chase a yield that pays the landlord first. Jake doesn't need a lecture on soil health. He's got a folder full of test results and a notebook that lists field quirks in pencil. But he can't write a check with ideal practices. He pays with bushels and time. Meanwhile, leases keep getting shorter. 2-year terms feel like a countdown clock. Banks notice. Credit lines tied to operating plans start asking for contingencies. What if you lose 320 acres? Who takes the pivot debt if the landlord ends the lease? Jake's answer is always the same. He'll find acres, he'll move equipment, he'll grind. But equipment doesn't like musical chairs. Neither do hired hands who need steady hours. Short terms move risk from the owner's column to the operators, then act surprised when operators act like they're in a sprint. Then there's the algorithm. In a dry year, Sam, a wheat grower in western Kansas, misses a rent milestone by a hair. The landlord's portal tracks performance to plan. The dashboard flashes red. A week later, a form letter ends the lease. No conversation. A larger operator, pre-approved by the fund, steps in with a promise to meet a higher yield benchmark based on a model that never sat in Sam's combine. Sam trucks his grain past fields he planted to a bin he doesn't get to fill anymore. Those aren't outliers, they're instructions written by incentives. When funds promise steady returns, variability has to go somewhere. It slides into the grower's decisions, the kind you make at dusk when you want to rest a field but can't pencil it. A shorter lease means you extract, not invest. You pick a high-dollar crop with a thirst you'll pay for later. You skip a margin cushion to hit a rent ratchet you didn't set. Follow the water because the rent demands it. Alicia leases 200 acres of vegetables in Arizona under an LLC chain she's never untangled. Her landlord, a private partnership, added a clause: irrigation improvements count as tenant capital unless the owner buys them out at a depreciated schedule. Alicia installs drip to keep beds alive in late summer. The return is survival, not appreciation. The next year, rent climbs because yields looked resilient. The drip line now props up a higher price she has to meet. Water becomes both lifeline and leash. Crop choice shifts under that pressure. In the high plains, irrigated corn keeps rent current where dryland sorghum might conserve moisture but miss the target. In California, almonds fill spreadsheets with tidy projections and bite into aquifers when rain forgets. On paper, rights accompany deeds. In practice, tenants face the moral math of pumping today to protect this year's balance sheet. The aquifer falls by inches. The lease rises by basis points. Human costs show up off-farm first. The co-op trims hours because orders arrive late. The school consolidates classes when a couple of families move after losing leases. The diner cuts breakfast Monday and Tuesday. Rural towns run on farm margin. When lease terms skim that margin to stabilize distant returns, services don't argue, they shrink. You don't see a crash. You hear silence at a Friday night ball game where the visiting team brings more fans than the home stands. There's a quieter squeeze, the upgrade trap. Tenants take on equipment payments sized for a stretched footprint because that's what it takes to win leases from landlords who want capacity. Bigger planters, newer combines, more pivots. The math skills are not the problem, the time horizon is. If a lease evaporates, capacity turns into overhead. Overhead hunts acres to feed itself. The hunt pushes bids up. A local operator loses to a platform that can absorb a short year with portfolio cash flow. The cycle rewards scale and penalizes patience. Not every landlord is indifferent. Some local owners keep rates fair, tie bumps to field conditions, and share drought pain. But the financialized slice grows, and with it the preference for rules that travel well. Rules like escalators indexed to futures. Rules like automatic termination on underperformance measured against a model that doesn't know what wind did to a north fence. Empathy gets priced as tracking error. Look at a micro story in Illinois. Naomi runs a soybean corn rotation on 1,100 leased acres across 4 landlords. After a wet spring, she proposes a switch to a cover crop-heavy plan to rebuild structure on 240 acres. 2 landlords agree, 2 say the rental escalator expects a conventional rotation, and deviation requires prior approval from investment. Investment answers in 2 weeks, no. Naomi plants the higher-risk rotation and pays more for nitrogen because she can't push the improvement timeline past a lease term. Her agronomist shakes his head. The soil knows what it wants. The spreadsheet knows what it's sold. When people ask whether this shows up in grocery stores, the answer is dull and heavy. Yes, but not as a headline. Price volatility gets passed through one contract at a time. A processor raises basis by a few cents to secure supply from operators who had to hit rent. A packer adjusts pricing after a season where high evaporation years trimmed yields. Households don't see a REIT name on the receipt. They feel a wobble in milk, eggs, and bread just when fuel climbs too. The chain is invisible by design. Underneath, stress loads bodies. Lee in Nebraska keeps a ledger where she writes rent on the first line in red ink. She sleeps with a radio by the bed during hail season because a midnight storm can erase a month of margin. She's not reckless, she's disciplined to the point of ritual. But the rituals don't change the contract structure that asks her to carry variance. She can't renegotiate weather. She can only call the landlord and hear what she already knows. It's policy. Policy isn't just a faceless rule, it's a calculation. Funds need to show stability. Stability prefers predictable rent. Predictable rent prefers short terms and escalators. Escalators prefer tenants who can make numbers behave. Making numbers behave prefers inputs that push yield and water that erases the difference between a model and a year. None of this is an evil plot. It's a machine with a throttle and no rearview mirror. A different kind of story sits quietly in a county clerk's drawer. A lease addendum outlines technology engagement. Tenants agree to install sensors provided by the owner's preferred platform and allow aggregated, anonymized data to be used for asset management. The platform belongs to a parent company tied to the fund. Field-level data flows upstream, improving underwriting and acquisition choices. Naomi doesn't own that intelligence, she produces it. Next lease cycle, the model knows which parcels to raise and which operators to replace. Information tilts the table without raising a voice. Meanwhile, families make choices that look small and feel final. Jake sells the old 12-row planter he kept for contour fields. The new landlord favors uniform patterns for drone imagery. Sam takes a job running a sprayer for the operator who replaced him because the bank wants to see payroll. Alicia turns down a CSA expansion because she can't promise acreage beyond her lease term. These are not dramatic confessions. They're practical cuts to fit a pattern someone else drew. There's another edge, insurance. Revenue protection helps, but coverage tied to historical yields can lag a string of stressful years. Lost checks arrive late, rent invoices arrive on time. More than one operator has used an indemnity to pay a landlord before paying themselves. That's not a complaint, it's a sequence. The sequence keeps the asset steady for investors and keeps families on the edge of decisions they didn't plan to face: sell equipment, lease pasture, pick up off-farm work. In the midst of all this, the old neighbor model, handshakes, 5-year promises, shared risk when a pivot fails, still exists in pockets. It keeps some places intact, but it's competing with a standardized lease packet you can send to 10 tenants in 10 counties without changing a line. The packet travels better than the handshake. The handshake feeds a town. What nobody wants to admit out loud is that uncertainty is profitable to the right end of the chain. If tenants compete for acres under short terms, owners can test price faster. If they rotate operators to reset expectations, they can present market discipline to investors. If someone folds, the platform acquires equipment at a discount or lines up a larger operator ready to push. That's not just agriculture, that's a playbook at scale. All of it loops back to kitchen table, where a number on a lease decides what gets planted. whether a field rests, and which bills wait in a stack under a ceramic bowl. The lie we started with sells land as safe because it's real. The truth in these rooms is that reality has to bend to a sheet of targets. And because food lives downstream of those targets, the margin that keeps a family farm alive is the margin that keeps your receipt boring. When that margin gets bought, streamlined, and pledged, the quiet stability everyone counts on becomes a variable, priced, packaged, and pushed onto the people least able to hedge it. The water beneath, rights, aquifers, invisible control. To follow the incentives, go underground. On paper, a deed is dirt, fences, and a mailbox. In practice, it's also a key to the water below or the water delivered by a ditch miles away. In most Western states, groundwater rights are tied to land, surface rights ride on seniority, and both can be transferred, leased, or banked through legal pathways that predate the funds now using them. Buy a farm and you don't just get soil. You quietly inherit a claim on a river that might be 100 miles upstream or a pocket of the Ogallala 1,000 feet down. That claim is where control shifts without a headline. Corporate buyers rarely stamp their names on the pivot tower. They don't need to. A limited liability company on a deed owns the well permits. A trust holds the shares of the LLC. A fund holds the trust. If you knock on the door to ask who's pumping, you'll meet a manager with a binder. The real decisions get made in a meeting where resource security is a line on a slide. Walk the high plains to see the stakes. The Ogallala/High Plains Aquifer props up about a third of U.S. crop and animal production. In counties across Kansas, Texas, and the Panhandle, the water table has been dropping for decades. Everyone knows it. What's changed is the pressure from rent targets layered on top of weather. High rent mandates reward crops that monetize the water fastest, irrigated corn for feed or ethanol, high-value vegetables on drip, over rotations that conserve moisture. When your lease escalates and your lender wants proof of capacity, you pivot on more acres and pump harder. The aquifer becomes collateral, not a commons. Meanwhile, in California's Central Valley, senior surface rights can make an orchard worth more as a water instrument than as almonds. Firms bought blocks during low-rate years, then watched Sustainable Groundwater Management Act plans tighten. The response wasn't to unplant out of caution, at least not first. It was to keep pumping under existing allocations, add wells where legal, and explore transfers, moving water from a farm district to an urban system for a premium. The portfolio reads orchard, the model reads option. The mechanics aren't exotic. Irrigation pivots and drip systems get booked as capital improvements. Leases stipulate that tenants maintain equipment and comply with district rules. But the meters, where they exist, feed patterns. A landlord sees flow rates and yields, then pairs them with futures prices and rent schedules. A strong year becomes a benchmark. The next year is judged against it, regardless of rainfall. The habit becomes extraction. Match or exceed last season's water-supported returns, or cede the lease to someone who will. In basins without strict controls, the paradox sharpens. Arizona's unregulated rural aquifers, for example, have drawn corporate-scale dairies and nut operations that legally pump hundreds of millions of gallons annually while nearby domestic wells run dry. Residents drill deeper. Farms install bigger pumps. The water level sinks like a closing fist. Local headlines tell the story through families hauling water in pickup tanks. Portfolio reports tell it through production resilience and asset performance. Water isn't just an input, it's collateral and hedge. In offering decks, you'll see careful phrasing, water-secure assets, proximity to conveyance, priority rights. Investors hear stability, managers hear flexibility. If yields dip, you can still borrow against the embedded value of water access, or you can pivot acres to a use that monetizes the right itself. Leases to cities, transfers within a basin, even speculative positions on future scarcity. The more the aquifer falls, the more the right to draw becomes a store of value. That's the quiet moral hazard embedded under the fence line. Leases can direct extraction patterns without ever mentioning the word aquifer. Rent escalators set targets that certain crops can meet only with irrigation. Expected production clauses nudge tenants toward water-heavy rotations when rain fails. Capital improvements clauses make tenants responsible for drip or pivot upgrades that once installed justify higher rent. The result is perverse. tenants finance the very systems that lock in their obligation to keep pumping. Parallel to wells, data streams reshape behavior. Precision irrigation sensors and flow meters feed platforms owned or preferred by landlords. Contracts grant aggregated, anonymized rights to the data. Those words sound harmless until you realize what's being aggregated: field-level depletion patterns, response to drought stress, well performance over time. That intelligence doesn't just optimize farming, it optimizes asset selection and rent pricing. The owner of the data knows which parcels sweat water into profit most efficiently and which tenants can be replaced to unlock more pumping. All of this sits inside a legal maze that rewards those who can pay to navigate it. Water banking programs allow rights holders to store or exchange allocations. Transfer hearings weigh beneficial use against community impact. Seniority in prior appropriation states can trump local need. Funds hire counsel who speak the dialect of acre feet and case law. Tenants hire someone who can make a phone call. In the gap, control consolidates. The person holding the shovel's handle gets told what's efficient, and the definition bends toward balance sheets. If you want a simple test for who holds power, follow a dry year through a contract. A tenant proposes fallowing a block to rebuild moisture and protect next year's yield. The owner cites rent terms and notes the possibility of a deficit mitigation clause: pay now, recover later if weather cooperates. Weather doesn't negotiate. The grower pumps to meet rent and hopes insurance backfills the gap. Insurance checks arrive after the season. The aquifer doesn't refill on schedule. There's a broader export hidden in supermarket aisles: virtual water. When a water-stressed basin grows alfalfa or almonds for export, it's shipping thousands of gallons per pound embedded in the crop. The ledger doesn't call it a pipeline, but that's what it is: water leaving stressed aquifers in the form of food or feed bound for distant markets. Investors call it comparative advantage. Communities call it a slow bleed. To be clear, not every fund pumps without restraint, and not every landlord treats water as a slot machine. There are operators and owners who set caps, share risk in drought, and tie rent to sustainable yields. Some districts meter rigorously and enforce limits that force everyone to bend. But the financialized model, scaled across states and time zones, prefers rules that can be repeated across a portfolio. Repeatable often means extractive, because regeneration takes time that a quarterly report won't grant. The optical trick is that water props up returns long enough to make fragility look like strength. As long as a well can be deepened, a transfer petition filed, or a lease pivoted to a crop with a higher water-to-dollar ratio, the numbers behave. The signal of stress isn't a crash. It's a drift: falling water tables measured in feet, then tens of feet, rising energy bills to lift water, salt creep in soils, canals rationed, neighbors drilling deeper and hitting air. That drift is slow enough to ignore in a presentation, and fast enough to empty a town's future. Unknown to many tenants, their leases sometimes include interruption rights on delivery from private ditches or third-party agreements that prioritize certain blocks when allocations tighten. Translation: in a crunch, some acres get water and others don't, not because of agronomy, but because a clause in a contract drew a circle around which fields mattered most to the owner's returns. A map in a file cabinet decides who harvests and who apologizes to a buyer. When the basin runs into a hard cap, mandated cuts, metered ceilings, or wells that simply stop producing, the paper logic climbs a ladder. Owners sell water-secure parcels at a premium and shed the marginal acres. Tenants on the wrong side of the cap face the end of leases with little leverage. Communities lose production, then jobs, then people. The portfolio rotates. The town shrinks. Here's the twist that ties back to your grocery receipt. Water turns a local problem into a national one through markets. A dry year in one basin triggers rent pressure and crop switches that ripple into regional supply. Processors widen their sourcing radius and adjust basis. Trucking spreads pinch. A dataset in a city shows resilient returns. A diner in a farm town posts shorter hours. This isn't fatalism, it's physics and contracts. The physics say aquifers deplete when withdrawals exceed recharge. The contracts say rent is due whether rain falls or not. When capital sits on top of both, scarcity becomes a financial input. That's the invisible control: water rights bundled into deeds, deeds bundled into vehicles, vehicles engineered to turn a falling water table into a stable investor story. While water props up returns, the securities machine above ground learns to slice the farm into tradable promises. That's where the risk multiplies in ways no well can fix. Slicing the farm: funds, REITs, crowdfunding, tokens. While water props up returns underground, the machine above ground learns to turn fields into slices that trade. Start with the most polished version, the Farmland REIT Roadshow. The deck opens with a map dotted by pins: coastal berries, Midwestern row crops, Western orchards, framed as geographic diversification. The voiceover promises a rent dividend engine that behaves like apartments, but with seasons instead of months. It's tidy, long-term net leases, escalators linked to market conditions, modest leverage, predictable distributions. The farmland itself fades behind phrases like core plus strategy and operational excellence through tenant partnerships. It sounds like comfort. It functions like scale. Drill into how the pitch works. First, gloss the variability. Instead of irrigation risk, call it resource security. Instead of crop failure, call it tenant selection. Instead of local weather, call it portfolio balance. Then emphasize liquidity, public shares, daily pricing, analyst coverage. The draw is that you can tap out with a click even if the tenant can't tap a well any deeper. The dividend is the hook. The story is the shield. Private funds echo the model with thicker documents and softer disclosures. They raise capital in vintages, close the fund, and hunt parcels that fit a template. The template is financial, not ecological: a target cap rate, a rent escalator structure, a tenant with scale. A capable mid-sized operator becomes platform-ready. The fund's mandate: low volatility, steady cash, upside on appreciation, filters every decision. If the numbers sing, the soil can wait its turn. Crowdfunding arrived as a friendly cousin. Own a slice of a specific farm for a few $1,000s. The website shows drone video, a smiling operator, and a simple promise: your cash helps buy the deed, rent and appreciation flow back to you. The structure is an LLC per parcel with the platform as manager. On the surface, it's intimacy. Underneath, it's a miniature of the same fee stack: acquisition fees, asset management fees, disposition fees. The tenant's risk hasn't moved. The audience has. Then come the wrappers designed for speed. ETFs track baskets of public farmland owners or agricultural real estate indices. The point isn't yield, it's exposure with intraday liquidity. Exposure invites momentum. Momentum invites leverage, total return swaps, margin options. The distance from a field in Tulia to a keystroke in Singapore shrinks to milliseconds. The price discovery that's supposed to reflect value starts reflecting flows. Tokenization tries to go smaller and faster still. A 2,000-acre block becomes 20,000 tokens on a blockchain. Each token claims a sliver of the rent stream and the eventual sale. A secondary market promises 24/7 trading and global access. Smart contracts distribute rent in stablecoins. The barrier to entry falls, the complexity rises. Now a harvest delay in Yakima can ripple through a Discord server where traders debate whether to dump their tokens before distributions slip. The field becomes a chat room sentiment object. Listen to how the leverage cycle threads through all of this. Rising NAVs in a REIT enable a credit facility expansion. New purchases lift comps. Higher comps justify another upsize. Private funds repeat the ladder with subscription lines and asset-level loans. Crowdfunders borrow against platform equity to add acquisitions that sustain growth narratives. Tokenizers tempt with staking yields and synthetic liquidity. At every layer, fees reward assets under management and transactions over outcomes. You don't have to intend a bubble to build one. You just have to keep feeding a structure designed to grow. Regulatory gaps widen as the structures proliferate. Real estate exemptions keep farm funds out of bank-style capital rules. Tokens tuck themselves under Reg D or Reg S, marketed to accredited wallets with terms that read like alphabet soup. ETFs ride on existing exchange rules that weren't built to test whether a farmland index actually maps to productive value on the ground. Call the assets infrastructure, and you inherit leniencies designed for bridges. Add sustainable, and you inherit marketing that outsprints auditing. Oversight fragments, responsibility blurs. Meanwhile, sales language keeps soothing: programmatic acquisitions, disciplined underwriting, tenant diligence framework. The words are technically accurate and emotionally anesthetic. They imply a process that can't possibly overreach because it's so carefully named. But process can be a funnel pointed at a cliff. The pressure to place capital doesn't pause for a dry 5-year climate projection or a basin adjudication creeping toward cuts. A term sheet moves faster than a watershed plan. You see the strain in human moments. A fund wins a bid on a mixed-use block, trees aging out, row crops between them, a sagging pump station. The underwriting assumes a replant financed by the tenant, rent stepping up in year 3, and a cost share on a new well. The tenant nods because the alternative is losing the lease. Year 2 arrives with a heat dome and a groundwater allocation trim. The tenant sprints to install micro sprinklers. The fund keeps the escalator because the deck promised it. The well pulls sand by late August. The tree line dies back. The fund's quarterly still reads on plan. The tenant's ledger doesn't. Crowdfunding's micro-stories rhyme. A platform markets a pasture as regenerative ready, leaning on keywords to attract ESG-minded investors. The lease, however, pegs rent to expected stocking rates based on a wet decade. 2 dry summers later, the operator proposes rest and lower density. The platform manager cites the offering's return profile. The pasture gets pushed. The soil loses cover. Investors receive a glossy update about operational learnings and adaptive management. The check clears, the grass doesn't. Tokenization adds a behavioral twist. Communities form around tickers, not towns. Holders celebrate buybacks and floor prices. They swarm comment sections when a tenant posts about a tough season, interpreting agronomy through the lens of token performance. Managers learn to communicate like meme stock CEOs, teasing partnerships, hinting at new acquisitions, promising enhanced distributions. The farm becomes content. The content feeds liquidity. Liquidity feeds the thesis. The season still lasts the same number of days. In the background, banks and private lenders write facilities that treat land bundles like any other collateral. A covenant breach can trigger a forced sale across multiple counties. A redemption wave in a fund can force a manager to dump non-core parcels into a thin market. Those sales reset comps downward, compress collateral values, and rattle lenders. The loop that lifted prices on the way up runs in reverse. None of this requires fraud or flames. It requires a mismatch between the speed of capital and the speed of agriculture. There's another slice few notice: data securitization. Platforms aggregate field telemetry, yield maps, moisture curves, pump loads, and package insights for underwriting and rental pricing. In some cases, they monetize it directly to input suppliers or insurers. The tenant supplies the signal by working the land. The owner captures the option by refining the signal into a pricing edge. It's a quiet derivative built from a farmer's day. Supporters argue the slicing democratizes ownership and funds improvements. Sometimes it does. A cold storage build can cut spoilage. A drain tile project can heal saturated ground. But the machine's default is to treat improvements as levers for higher rent and richer multiples. If a tenant installs drip with their capital, a manager can package the upgraded asset into a premium sale, book a disposition fee, and move on. The tenant negotiates with the next owner or leaves behind a system that will ask the next operator to pump as hard as the lease requires. Regulatory fixes get proposed: standardized disclosures on rent-to-yield ratios, hard caps on leverage at the vehicle level, beneficial owner registries for land and water, stewardship covenants tied to lease tax treatment. All useful. None change the core incentive if price discovery remains driven by liquidity rather than productive value. You can rate a bond without changing the debt behind it. You can inspect a pivot without changing the aquifer beneath it. Here's where it gets interesting. The bubble logic mirrors housing even when the products claim they don't. Houses were sliced into tranches that looked safer together than separate. Farms are now sliced into securities that look safer in a basket than in a basin. In both cases, the story outpaced the substrate. In both, small misses, rainfall, rates, regulation, can cascade through structures optimized for stability. What nobody wants to say on a panel is simple: food doesn't clear through an exchange. It clears through a season, and a season can't be sped up by a redemption window. So the farm gets sliced into dividends, tokens, fee streams, data packets, and redemption cycles. until the people on the ground carry a stack of invisible claims layered above their heads. As long as prices rise, the machine hums. When the weather or the water or the rates say no, the hum turns into a shudder you can feel in town before anyone rings a bell on a trading floor. The housing replay, detachment, leverage, dominoes. You've seen this movie. In housing, prices sprinted ahead of wages while lenders stacked products that looked safe until they weren't. In farmland, land values sprint ahead of per-acre profits while funds stack vehicles that promise stability as long as appreciation keeps doing the heavy lifting. Detachment is the first rhyme. When rent claims and NAV marks matter more than what a field can produce over a decade, the asset stops behaving like a farm and starts behaving like a chip. Stakes first. For operators, the gap between rent and realistic yield is a margin tax with no ballot. For towns, a rent-driven crop switch can pull water, spike inputs, and hollow payrolls. For everyone eating, volatility climbs into prices when the gap is paid forward through contracts. That's why detachment isn't an academic phrase. It's the precondition for the dominoes. Action as it unfolded. During the low-rate years, managers borrowed against rising marks to expand. Bankers offered facilities secured by portfolios whose values leaned on each other. Appraisers penciled comps set by funds chasing scale. Meanwhile, investors bought the story that farmland's drawdowns were mild and mean reverting, so paper exposure looked gentler than equities. Layer by layer, a system optimized for steady lines grew more sensitive to the one thing farmland can't control: the cost of money. Here's where leverage hides. It isn't just loans, it's expectations. Pension models build in 6 to 8% from real assets. Consultants slot farmland into that box. REITs target dividends that assume escalators stick. Private funds promise IRRs that assume exits at uplifted multiples. If prices pause, projected returns vanish even without a foreclosure. That's leverage through design. A flat year becomes a shock because the structure can't absorb stillness. This was the moment everything changed. Rates rose, spreads narrowed, credit lines that felt harmless began to bite. Managers lifted rents to protect distributions. Non-core parcels hit the market into thinner demand. Crowdfunders slowed redemptions. A couple of forced sales reset comps lower in counties that hadn't seen a discount in years. Lenders reran covenants. The feedback loop reversed, quietly first. Impact immediate and rippling. Operators found leases repriced mid-cycle under market update clauses. Some walked. Larger platforms absorbed acres, bringing capacity and lender comfort, but also more standardized terms. Local banks, less exposed to the REIT layer, tightened operating credit because collateral values softened. Processors widened basis to secure supply from a map that suddenly looked patchy. None of this made headlines. It made checkout lines pricier and towns thinner. Asset-backed structures amplified the wobble. Subscription lines on private funds had to be retired with cash from dispositions. REITs managed optics by swapping assets, sell aging trees here, buy row crop there, masking net pressure with motion. ETFs transmitted sentiment. A negative quarter pulled money out of baskets that owned farmland proxies alongside other real asset names, dropping prices for reasons unrelated to rainfall. The machinery of diversification diversified the shock. Behavioral slogans kept the pedal down until the curve bent. Land always goes up, and they're not making more of it. Insulated decision makers from uncomfortable math. Climate variance eats predictability, water caps are real law, and per-acre profits haven't kept pace with per-acre prices in key regions. A slogan isn't a hedge, it's an accelerant. Rate sensitivity delivered the next beat. As interest expense rose, funds shifted to preserve optics, cut distributions, lift fees where allowed, push tenants harder. The tenants had two tools: extract more from soil and water now or exit. Many extracted, some exited. Exits concentrated acres under owners who manage by spreadsheet. Concentration reduces shock absorbers. One mispriced rent policy from a large landlord can tilt a county. Meanwhile, global capital turned local signals into global moves. A sovereign fund trimming its real assets, sliced to rebalance out of inflation trades, sold a position in a farmland partnership. That triggered a redemption clause. The manager listed parcels in 3 states. Sales cleared below peak marks. An insurer watching the prints widened haircuts on its credit line to another manager. That manager announced a disciplined pause in acquisitions. Brokers in 2 counties called it a breather. Tenants called it uncertainty. What nobody knew at the time, data streams became a hidden domino. Platforms that priced rent using normalized performance penalized operators who conserved water in dry years because outputs looked low versus models. In the next cycle, parcels where tenants had extracted harder were labeled top quartile. Rents followed the label. The algorithm learned the wrong lesson. Detachment created fragility. Leverage, financial, behavioral, and contractual, made it brittle. Dominoes sat on tables in New York, London, and Singapore, but they fell into school budgets, co-op invoices, and repair shops on county roads. The housing echo isn't about subprime paperwork. It's about a system that confuses tradable stability with durable production and then discovers, late, that seasons don't compound on command. There's one more rhyme. In housing, originate to distribute diluted accountability. In farmland, acquire to allocate does the same. Fees accrue as assets move and scale grows. Consequences accrue where rain misses and wells cough air. When the next shock hits, drought stack, rates spike, exports snap, redemption windows will open faster than aquifers recharge. And that timing gap is where a market story turns into a grocery bill. The global land rush, sovereigns, pensions, offshore. While the housing echo plays at home, the money isn't just American. It flies in on long horizons with short signatures. Sovereign wealth funds arrive first, quiet mandates from oil, minerals, or trade surpluses looking for inflation hedges that feel concrete. They don't need quarterly drama. They want 30 years of indexed rent, export exposure, and when possible, water security buried in the deed. 1,000 miles from any pivot, a committee approves agriculture real assets, North America, and a manager starts calling brokers in Nebraska. Pensions follow with scale that dwarfs counties. The brief is simple: match liabilities with stable cash. Farmland reads like a bond with sunshine. A trustee glances at correlation charts, nods at the low volatility line, and approves an allocation to a partnership owning tracts across 3 time zones. Teachers in Toronto, nurses in Oslo, rail workers in Sydney, retirement checks far away get tied to rents on rows of corn and almonds they'll never see. Insurers like the duration. Premiums today, claims tomorrow, assets that sit in between. Farmland leases slot in as steady coupons that won't vanish if an office tower empties. They buy through separate accounts run by the same firms courting pensions, stacking influence without stacking names on county rolls. Their risk lens focuses on interest rates, not irrigation stress. They prefer certainty and outsource the rest. Then the veils. Offshore layers solve 2 problems at once: tax and attention. A Cayman or Luxembourg feeder vehicle channels capital into US land while keeping the beneficial owner out of local headlines. The deed lists an LLC. The LLC rolls up to a trust. The trust rolls into a fund domiciled, where sunshine is for vacations and statutes are friendlier. Ask a county clerk who owns the quarter section and you'll get a registered agent's desk. Geopolitics rides along. Export agriculture isn't an accident of taste, it's a strategy. A sovereign fund with a food security mandate doesn't need to buy grain elevators to shape flows. It just needs to prefer operators who reliably hit contract volumes for overseas buyers. Logistics adjust. Rail slots, cold storage, port capacity prioritized to meet export windows. Local grocery shelves don't empty, but local resilience thins when the best acres are scheduled for ships. Water footprints cross borders without passports. Importing almonds, hay, or beef is importing the water it took to grow them, virtual water moving through trade. For capital, it's diversification. For basins, it's depletion priced into an index. A city on one continent secures diet stability by leaning on aquifers on another. The paperwork celebrates efficiency. The wells measure the cost. Scale compounds behavior. When a global pool wants exposure, it doesn't nibble. It buys platforms, operators with thousands of acres and a pipeline of deals. Terms standardize, rents index, lease lengths shrink to match fund lives and rate cycles. One decision in an investment committee sets incentives for 10 counties. If that decision leans on appreciation and export contracts, that's the music everyone dances to. Concentration creates chokepoints. A handful of landlords can tilt rents across a region. A handful of processors can dictate basis. A handful of logistics hubs can turn a weather event into a supply shock. Tie all three to capital that rebalance portfolios on macro headlines, and a drought becomes a financial event before it becomes a news story. You've seen this movie, housing, but with dirt and water connected to ports and pensions. Chokepoints and ecological erosion. While global capital sets the tempo, the beat lands in fields as monocultures strapped to debt service and rent targets. In the Delta, cotton slips under pressure from spreadsheets that like corn's futures liquidity. In the high plains, irrigated corn outbids dryland rotations because it pays rent on time. In the Central Valley, almonds march in neat blocks that please lenders and dashboards. Diversity thins. A region's risk concentrates into a single crop's weather, pest, and water profile. It looks efficient on a map. It behaves brittle in a storm. Stakes first. When a county leans on one high-dollar crop to cover escalators and interest, the entire local economy inherits that crop's failure mode. A heat dome becomes a payroll event. A late frost becomes a school budget. Inputs from fertilizer to power to diesel tie to a single planting calendar. One miss and the co-op, the repair shop, the diner, and the church pantry all feel it. This isn't just ecology. It's the social wiring of a place braided with a commodity's volatility. Action as it unfolded. Input contracts lock operators into sequences calibrated to financier models. Seed packages are bundled with chemical regimes priced on expected production, not on what soils need after 2 punishing summers. A credit line discounts if you select the stack that meets the landlord's yield target. Crop insurance aligns with the package's history, reinforcing the path. The farmer's discretion shrinks to timing and prayer. The model sets the play. The season decides whether it works. Soil health becomes a negotiable that loses the negotiation. Fallow time slips first, too expensive under 2-year lease with an escalator. Cover crops get demoted to optional, not because the operator doubts them, but because cash flow does. Residue gets bailed to cover payment. Compaction deepens when heavier machines sprint to plant narrow windows that match contract delivery dates. Organic matter inches down, water infiltration slows, and the next rain runs off faster than the last. The invoice arrives, the infiltration doesn't. Meanwhile, climate variance breaks the premise baked into underwriting. Basis risk, the difference between a hedge and reality, widens when local events diverge from the index. A hail band slices a band through 3 counties while futures barely blink. A smoke-stained summer cuts photosynthesis. The model hasn't seen that series. A warm winter fattens pest survival into spring. Insurance helps sometimes. It doesn't rebuild structure, recharge aquifers, or lengthen leases. It writes a check to a calendar, not a root system. Here's the chain you can follow across a single year. Drought drags through June. River allocations tighten in July. Electricity rates spike as pumps pull from deeper screens. By August, a rate hike lands on the manager's desk. September brings a rent reset letter with market alignment language. October, the banker asks for updated collateral values because a fund dumped non-core parcels nearby. November, the operator switches next year's plan to a thirstier, high-price crop to chase cash. December, the co-op extends terms. January, the kid down the road takes a job in town. It looks like life. It is a feedback loop. Unknown to most investors, the chokepoints aren't just in fields. They're baked into logistics nodes that sit upstream of a cashier's scanner. A region with one reliable elevator or one cold storage cluster treats a warehouse like a valve. If rent pressure pushes a crop switch that floods that node with uniform product, any hiccup, labor, a blown compressor, a contaminated lot, backs trucks for miles, tripping contract penalties that ladder back into next season's rent negotiation. A warehouse in October becomes a classroom in March. Now layer on power. Irrigation runs on electricity or diesel. When utilities ration in heat waves, pivot cycles lengthen and stress compounds on trees and rows already near their limits. Managers call it operational variability. Growers call it fruit drop and tip burn. Deferred maintenance, another quiet casualty of squeezed margins, turns a solvable failure into a season-ending one when a pump seal gives up in a week, the electrician can't come. A $600 part becomes a 5-figure swing. The spreadsheet has no cell for the neighbor who used to fix it for beer and thanks. Micro-stories make this concrete. In Tulia County, a mixed block straddling an aging well sees allocations cut. The tenant proposes yanking trees early and returning to a deep-rooted cover for 2 years. The landlord's asset manager, on a quarterly call, floats a different path. Push one more harvest with supplemental trucking from a rented well 2 parcels over. They try. The rented well throws sand. The fruit grades down. The buyer downgrades the lot. The operator eats the difference to protect the relationship. The landlord reports resilient performance in challenging conditions. In western Kansas, a row crop outfit balancing dryland and pivot ground tries to rest a quarter. The lease's expected production clause trips and sets a penalty equal to the escalator they were trying to avoid. They plant anyway, pull the water, and hit the number. The pivot motor fails 2 weeks before peak stress. A refurbished unit is available, cash only. They wire it. They make the season. They miss the note in January. A larger operator acquires their remaining leases in March. The county school board votes to combine bus routes. This is how ecological erosion becomes institutional. A portfolio's standardized terms ripple into uniform decisions on the ground, squeezing out the local improvisation that kept landscapes resilient. The old patchwork, alfalfa here, small grains there, pasture shifting with rain, gets flattened by yield targets and payment schedules. Resilience hides in diversity and slack. Financial engineering removes both. Meanwhile, the data loop punishes deviation. A tenant who chooses to rest ground or shift to a low water rotation logs underperformance against a normalized model. Next cycle, that parcel's rent is adjusted up to the peer group median, or the tenant is replaced by someone who promises to meet the number. The signal is clear. Conservation is a luxury priced as failure. The algorithm didn't set out to undermine stewardship. It learned the returns investors liked and reinforced the behaviors that produced them, short-term. When pressure builds across a basin, the chokepoints hum in unison. A processing plant running near capacity gets hit by a climate-driven labor outage. A bridge out of service adds an hour to truck routes. A fertilizer plant's maintenance outage coincides with a planting window, forcing higher-priced spot buys. These are small events alone. Together, they nudge a season into deficit. The only lever that moves fast is rent, and rent moves the wrong direction, up, to satisfy covenants above the field. What nobody knew at the time was how quickly exits compound the ecological damage. A landlord pivoting acreage to solar because interconnection finally clears may pencil out for investors. On the ground, a farm supply store loses a top customer, a custom harvester's schedule collapses, and a dust bowl forms on a wind-exposed pad because no one budgets for cover in a construction timeline. Warehousing follows a similar arc. A site near a highway trades rows for concrete. The town loses a harvest. It gains forklift jobs for a while and then loses them when a tenant consolidates to a different market. Look at one more chain: drought plus rate hike plus rent reset. Drought reduces yield and raises energy costs. Rate hike shrinks fund spreads. Rent reset tries to reclaim the spread from the tenant. That forces a crop switch to higher water use and input intensity. The switch pushes regional demand for water and inputs into a stressed grid and supply chain. A failure at any node, well, power processor, converts a financial adjustment into a supply shock. Grocery prices don't care whether the trigger was a board meeting or a ridge of high pressure. They respond to scarcity. The board meeting made scarcity more likely. There's a way this story ends differently, but not on its current rails. Leases that lengthen and tie rent to regenerative benchmarks create slack. Input contracts that decouple from a single stack restore agronomic choice. Water accounting that bites reduces the moral hazard of pumping today and modeling tomorrow. But incentives as written reward extraction and speed. That's why monocultures spread, chokepoints harden, and soils sigh under machines that used to move slower. While pressure builds, capital looks for exits. Solar leases pay steady. Warehouse conversions flip fast. Water transfers book gains cleanly. Profits leave on schedule. Communities stay behind with thinner soils, fewer neighbors, and a school board deciding whether to drop art or the bus route to save a teacher. When someone says the market will adjust, the question is who moves and who can't. Fields can rest if contracts allow. Towns can't rest if contracts don't care. Everything was about to change when the first big landlord in a region tried to sell into a thinner market and discovered the bid had stepped back. That's when the financial model started to meet the ecological one, and both began testing which rules mattered more. Exit strategies and the invisible owners. When pressure builds, capital looks for doors that swing open on schedule. The first is sunlight. A parcel that struggled to meet rent targets as a farm can become a tidy income stream as a solar lease. A developer offers 30 years of fixed payments indexed to inflation, plus an upfront option fee. The numbers land like rain after a dry season. The farm crew sees survey stakes. The spreadsheet sees duration. Panels arrive before anyone debates windbreaks or dust control. Interconnection approvals, not irrigation schedules, decide the future of those acres. Warehousing is the second door. A field near a highway or rail spur pencils as a logistics node faster than it pencils as a rotation. A broker whispers that demand from e-commerce tenants is strong, that a 500,000 square foot box will pay more per acre than tomatoes or wheat ever did. Permits move, topsoil scrapes, concrete pours. Short-term construction wages arrive, long-term farm jobs don't. The parcel that once paid the co-op's light bill now pays a REIT's dividend through a different wrapper. Water is the third door, and it's the quietest. Where rights can move, a portfolio turns scarcity into strategy. A manager files to transfer agricultural water to municipal use, books a gain, and frames it as regional optimization. In basins with banking programs, rights get parked for later, appreciating as cuts tighten. In places with priority systems, seniority sells at a premium. The farm remains on paper for a season or two, then drifts toward non-irrigated or future redevelopment. The return shows up clean, the pumps go still. Asset flexibility becomes a pitch, optionality across energy, logistics, and water. It reads like prudence in a deck. On the ground, it's a set of exits that reward capital for leaving faster than communities can replace what leaves. A landlord doesn't have to be cruel to be extractive. The structure does the deciding. When interest expense rises and redemptions loom, panel payments and transfer checks solve problems crops can't. Title hides the hand turning the knob. A deed lists a limited liability company with a name that sounds like a ridge or a bird. That LLC is owned by a Delaware LLC, owned by a trust, custodied by a nominee. The fund that controls it files aggregate ownership with regulators and reports exposure by region. County clerks see local agents. Tenants see property managers with call scripts. Neighbors see trucks with plates from 2 states away. The beneficial owner could be a pension in Canada, an insurer in Germany, a sovereign fund in the Gulf, a family office in New York. All legitimate, all distant. This decision would haunt them because distance erases friction. A boardroom that approves a pivot from crops to panels doesn't pass the shuttered diner twice a day. A committee that signs a water transfer letter won't meet the homeowner whose well goes dry and can't afford a deeper pump. The manager on the phone remains polite, keeps a calm tone, and cites policy. Policy moves money. It doesn't move kids back into a shrinking school. Data compounds the gap. Precision platforms that tenants are nudged to use through technology engagement clauses, pipe field intelligence upstream. Moisture, pump loads, yield maps, even machine hours get aggregated into dashboards the owner controls. That information doesn't just improve irrigation timing, it guides disposition strategy. A parcel with declining well performance and strong solar irradiance slides into a conversion candidate view. A block with senior rights and a nearby pipeline corridor becomes transfer ready. The farmer supplies the signal by working, the owner monetizes the option by leaving. When rates spike or commodity prices sag, pressure points line up. Credit facilities tighten, covenants sharpen, and capital calls come due. Managers triage, sell the non-core, pause distributions, lift rents, or execute exits. A pivot to solar closes a quarter. A warehouse pre-lease buys time with lenders. A water transfer clears a redemption queue. Each move is rational at the vehicle level. Seen from town, it looks like pieces of a community quietly unhooking. LLC chains and custodial nominees shield more than tax positions, they shield narrative. A family that's rented the south half for 20 years loses it to a conversion. The notice arrives from a property manager. The owner of record is a shell with a P.O. box. Local reporters ask who made the call. The answer is the market. The truth is a vote taken by people whose names never appear in the minutes of a county meeting. They aren't villains, they're absent. There's a fourth exit, land banking. Funds buy fringe parcels and park them, letting entitlement rumors seep into appraisal comps. A seasonal crop runs for a few years to carry taxes and soft costs. Fences stay up barely, equipment dodges survey pins. A sale to a developer appears 5 years later at a multiple that dwarfs any yield plan. The tenant gets a clean thank you and a short runway to relocate. Market finds best use, the brochure says. Market never promised to feed your town. Pressure also travels through change of control clauses. A fund sells its farmland platform to a larger asset manager. Tenants get a letter, your landlord is now someone else. Lease terms remain in force, but policy updates arrive, technology requirements, rent index tweaks, insurance riders, an algorithm grades tenant performance across the newly merged portfolio. Replacement lists get drafted. A person who brought cookies to the first lease signing learns they've become a row in a sort. Unknown to them, across town, the co-op adjusts orders after hearing which leases got pulled. A processor calls to ask whether deliveries will hold. A bank runs a borrower's operating line with fewer acres. The dominoes are quiet, but they land in sequence. Exit strategy in a fund is entry strategy for uncertainty in a county. Water rights monetization turns law into leverage. In Texas or Colorado, a rights holder can negotiate long-term leases to urban utilities. A rancher once sold small parcels to neighbors. A fund sells acre feet to a pipeline. In Arizona's unregulated pockets, mega dairies arrived to pump within their rights. When scrutiny sharpened, some sold assets and left, leaving locals to drill deeper. The legal system rewards those who can hire counsel fluent in the dialect of beneficial use and no injury. Tenants negotiate with weather, owners negotiate with attorneys. Guess which one moves the dial? Data ownership is the most invisible exit. Field telemetry, aggregated across portfolios, becomes a pricing edge sold to lenders, insurers, and rival funds. The value migrates upstream into underwriting models, acquisition strategies, and rent schedules. A tenant contributes the raw material by surviving seasons. They don't see a royalty when their hard years teach a model to squeeze another percent. Their decisions become someone else's alpha. When markets thin, forced sellers reveal where control sits. A fund facing redemptions lists parcels fast. Buyers show up with guarded bids. Sale prices print below peak marks, resetting comps that underpin loan books at local banks. Collateral gets haircut. Lines get tightened. Tenants who sat out an escalator find their bank asking for more security. A transaction between two shells becomes a conversation at a kitchen table about selling a tractor. Regulatory gaps keep the lights green. Beneficial owner registries don't include land and water in enough states. Securities oversight doesn't reach deeply into private offerings that slice farms into fractional products. State water boards move on multi-year timelines. Fund lives measure performance quarterly. This timing mismatch lets exits run ahead of guardrails. By the time a cap bites, an owner with options has already rotated out. The basin stays with less water and fewer operators. It's tempting to think transparency fixes this. It helps. If county records listed beneficial owners, if leases disclosed rent-to-yield ratios, if water accounting were public and metered, communities could at least point to the fingerprints. But names don't change incentives. As long as a manager is rewarded for delivering steady returns regardless of whether acres farm or rest, the exits will glow. As long as water rights appreciate through scarcity, transfers will beckon. As long as logistics pay a premium near interchanges, concrete will outbid cover crops on a map. Micro-stories show how exits feel in bodies. In the valley, Manuel's crew finishes its last prune harvest on a block slated for panels. He pays out bonuses and lets 2 men go with hugs and numbers for cousins near Madera. He keeps 3, pivots to a smaller lease farther south, and sells a shaker that doesn't fit the new trees. The buyer arrives in a truck with an out-of-state plate. In Nebraska, Lee gets a notice that her lease will be repriced and reevaluated due to a strategic portfolio review. She calls the number and hears a courteous voice that can't tell her where the decisions happen. She plants anyway because she can't not. Through it all, the invisible owners remain consistent. They don't wake up to hurt anyone. They wake up to meet targets. Those targets translate into exits that make perfect sense one parcel at a time and gut a region when aggregated. A portfolio manager rotates from farms to solar, from water to cities, from crops to boxes. A town rotates from farm seasons to a schedule that doesn't match the school calendar. Stability travels. It doesn't always arrive where it left. Pressure points don't need conspiracy to trigger sell-offs. Rate spikes, regulatory shifts, or a commodity dip can be enough. A state tightens groundwater rules, a fund files to optimize and lists parcels without secure allocations. A dry winter cuts snowpack, allocations shrink, rent escalators hold. A processor drops a contract, a lender pulls back, a manager accelerates a warehouse plan. None of these moves violate a law. They violate a rhythm that kept places intact. We've seen land debt snap before. The difference now is the reach and the anonymity. In the 1980s, you knew the bank manager's name. Today, the decision might sit behind 5 shells and a fund name that sounds like a hiking trail. When it turns cleanly, on time, with signatures, and without a door you can knock on. Echoes of the 198s. Repeat pain, new scale. To see what's coming, walk back to the last time land debt snapped. In the early 198s, interest rates climbed into the teens, grain prices sagged, and collateral values cracked. Auctions became social events no one wanted, with neighbors standing shoulder to shoulder while a family's history turned into lots. The bank manager knew your kids' names, but the math didn't blink. Tractors rolled away. Signs went up. The pain had a phone number. What happened next mattered for decades. Consolidation set in, operators with stronger balance sheets absorbed acres, local lenders retrenched, towns stretched fewer dollars farther. Survivors learned discipline the hard way: keep leverage tight, diversify where you can, never confuse a good year with a trend. It wasn't wisdom on a slide. It was muscle memory built from loss. Now run that muscle memory against a different landscape. Leverage today isn't stacked inside one farmhouse ledger the way it was. It's layered into vehicles, REITs, funds, separate accounts that sit between the deed and the dinner table. Rate sensitivity still bites, but the bite lands through covenants at the fund level, redemption windows, and board decisions made far from county roads. In the 198s, a call came from Main Street. Now the call pings from a compliance inbox. The stakes widened too. Back then, local banks carried a big share of farm notes. Losses hit towns, but the contagion stayed mostly regional. Today, pensions, insurers, and sovereign funds hold exposure packaged as stability. A price wobble in 3 counties can ripple through a portfolio built to pay retirees in cities 1,000 miles away. A redemption request can translate into a non-core disposition that resets comps for everyone down the gravel road. Action as it's unfolding rhymes without repeating. Rates rose off the floor, funds trimmed distributions and lifted rents to protect marks. A few forced sales printed below peak, lenders sharpened pencils, operators with short leases faced market realignments that felt like 198's resets with a twist. The person delivering the news can't meet for coffee. They're in a different time zone. Differences go deeper than distance. Data now decides who gets squeezed. Field telemetry informs underwriting. Normalized performance ranks tenants against models that never sat in a hailstorm. In the 198s, a banker might give you a season based on character and rain gauges. Today, a dashboard flags underperformance, and an algorithm suggests replacement to guard a dividend promise. Mercy became tracking error. Globalization adds another turn. Export contracts and logistics slots bind acres to ships and ports. In the 198s, a poor harvest mostly meant local shortfall and local substitution. Now, a weather stack in one basin collides with a portfolio's need for steady output to meet forward commitments abroad. The strain isn't just agronomic. It's geopolitical, priced in basis points and sailing schedules. Still, one lesson holds. When land values detach from what ground can earn, gravity shows up. In the 198s, gravity arrived through rates and recession. Today, it walks in with rates plus water caps, climate variance, and structures that assume appreciation. Operators feel it first, tighter margins, harder choices, shorter terms. Communities feel it next, closed doors, consolidated services, kids leaving. Investors feel it last, slower lines on quarterly charts. In the aftermath back then, policy tried to stitch safety nets. Mediation programs, ag credit reforms, extensions where possible. Some worked. Others calcified power at larger scales. This time, reforms have to chase different pressure points: beneficial owner transparency for land and water, lease standards that trade a bit of return smoothness for soil and aquifer slack, leverage caps at the vehicle level, data rights that keep tenant intelligence from becoming a weapon against them. But reforms don't mean much if incentives don't budge. In the 198s, families learn to live inside cash flow. Today, vehicles need to learn to live inside carrying capacity. That means returns anchored to regenerative productivity, not scarcity slogans, rent escalators that bend to basin science, patience measured in harvests, not quarters. The alternative is familiar, a wave of tidy, rational decisions that, aggregated, break the places we ask to feed us. We've seen land snap before. The difference now is scale and anonymity. When this machine slips, it won't be a single auction in a church basement. It'll be a series of clean transactions, compliant and quiet, that leave the same ache. The names will be new, the story won't. The counterplays, policy, co-ops, water guardrails. If collapse isn't inevitable, it starts here, with rules that slow the machine and give fields room to breathe. Not slogans, structures, the kind that change a lease before they change a life. Ownership first. You can't fix what you can't see. Beneficial owner registries for land and water strip the masks off LLC chains so counties know who calls the shots. Not just a mailing address, who gets distributions, who votes, who signs transfer papers. Pair that with disclosure triggers, cross a regional acreage threshold and you file a simple public sheet. Acres, water rights attached, average rent-to-yield ratio by county. It won't stop a deal. It will change how the next one gets priced. Caps follow vision. Several states already fence out foreign governments from strategic parcels, extend the logic to concentration. Not xenophobia, resilience. Set regional caps on institutional control within basins or counties, phased and reviewable, with exemptions for community trusts and producer co-ops. The goal isn't purity. It's diversity of decision makers, so one rent policy can't tilt a school board. Leases are the hinge. If the pressure lands through terms, relief begins there. Stewardship leases trade a point of yield for years of stability. 3 pillars, longer terms, 7 to 10 years, tied to regenerative benchmarks. Shared risk clauses that flex rent down during declared drought or allocation cuts. And soil and water metrics that pay for recovery, not just extraction. You can write it cleanly, hit agreed soil, organic matter gains, cover crop acreage, and irrigation efficiency, and a rent credit kicks in. Slip, because weather wins, and the credit suspends without penalty. The contract breathes with the season instead of against it. Risk needs a wider spine. Shared risk contracts index a portion of rent to field-level outcomes rather than distant futures. Not a pure revenue share that turns farmers into price takers twice, but a hybrid, a base low enough to clear in a bad year plus a transparent band tied to delivered quality and volumes. At a drought rider, if allocations fall below an agreed threshold or wells hit a metered cap, the index band shrinks by formula. No bargaining at midnight. A clause turns chaos into math. Money has to move differently. Community finance brings deeds back within reach without asking families to outbid balance sheets. Expand right of first refusal laws so sitting tenants or local trusts get a timed shot at matching a bid. Seed county-level revolving funds that close gaps when banks hesitate. Offer state-backed guarantees for stewardship mortgages where repayment is anchored to long leases and measurable soil and water outcomes. Pension funds hungry for impact don't need a new product. They need a patient sleeve that accepts single-digit returns to anchor local ownership. The coupon is lower, the spillover is higher. Co-ops aren't nostalgia, they're leverage. Producer co-ops can hold land, negotiate inputs outside single-stack bundles, and sell into processors with enough volume to resist predatory basis moves. Water co-ops matter even more. In metered basins, shared accounting and pooled rights reduce panic pumping. Write bylaws that forbid transfers out of district without a supermajority. The vote becomes a guardrail that a redemption window can't push past. Water guardrails have to bite. Metering is table stakes, wells, conveyance, and on-farm delivery measured and reported in acre-feet publicly. Basin caps set by hydrologists, not politics, laddered down over years with clear enforcement and trading only within sustainable limits. No transfers across stressed basins. No paper recharge without demonstrated wet year storage, and measured return flows. Make beneficial use mean within carrying capacity, and put a real penalty on violations, reduced future allocations, not just fines that read like fees. Cities aren't villains if they plan like neighbors. Agricultural to urban transfers have to move last, not first. Require ag offset plans when municipalities seek long-term leases, funding for on-farm efficiency that stays with the farm, fallow and restore programs paid up front, and local replacement acres for critical crops where feasible. If a city wants stability, it helps build it where the water leaves. Data needs a bill of rights. Field telemetry belongs to the people who produce it. Bake data ownership clauses into leases. Tenants hold raw data. Landlords access aggregated metrics for asset care, not rent ratchets. Third-party monetization requires revenue sharing or is banned outright. If a model learns from a grower's grit, the grower should see more than a rent increase as a thank you. Regulation has to close the speed gap. At the vehicle level, cap leverage against farmland portfolios and require a reserve for drought years, a real cash buffer that can support rent flexibility without forced sales. Mandate standardized disclosures, rent-to-yield ratios, water source mix, basin stress scores, and lease length distributions. If a fund calls an orchard water secure, it shows the adjudication status and metered history. If it brands sustainable, it publishes soil metrics across time. Labeling without auditing is a lullaby. Give counties a switch. Tie local tax abatements and fast-track permits to stewardship covenants recorded on title, soil protection, water caps, and conversion guardrails. Break them, lose the abatement and face clawbacks. Keep them, and renewals are automatic. Policy becomes a business model, not a press release. None of this lands without enforcement that lives where the wells do. Basin boards with producer seats, tribal seats, municipal seats, and independent hydrologists vote cuts and publish meter data weekly. State AGs get standing to pierce shells in cases of evasion. Courts get timelines measured in seasons, not years, for water disputes. If agriculture moves at the speed of rain, the rules have to move faster than a prospectus. Does it cost? Yes, but the bill shows up now or later. Later arrives as trucking water to dry towns, rebuilding schools after exits, and propping up pensions that mistook aquifers for annuities. The cheaper path is the slower one: leases that reward care, books that reward patience, and water accounting that makes scarcity a boundary, not a business plan. None of it sticks unless the incentives change. And incentives change when value is repriced to what the ground can actually produce without borrowing from tomorrow's water. That's where this turns from guardrails to a different kind of math. Repricing reality from scarcity myths to productive value. If the machine runs on a story, the reset starts with a different one. Not they're not making more land, but what can this acre produce year after year without borrowing water from tomorrow? That's a quieter slogan, and it doesn't sell roadshows. It does keep towns alive. Anchor value to net regenerative productivity, not theoretical yield, not last decade's wet cycle. Net after inputs, after water, after the wear you put on the soil to hit a rent escalator. Put a number on what the field can do under practices that rebuild the base. Cover crops, longer rotations, fewer passes, precise irrigation, real rest. Call it carrying capacity and force everything, leases, appraisals, loan books, to live inside it. If a basin hydrologist says the cap is here, valuation doesn't get to pretend it's there. Debt has to learn that language. Loan to yield becomes loan to carrying capacity, stress tested against water and climate variance. A lender who underwrites a pivot on paper should underwrite the basin's recharge in practice. Make drought not a footnote but a table in the credit memo. 3-year stack, allocation cuts, energy prices for lifts, and a modeled recovery path that assumes slower rotations, not miracles. If the note only pencils when the aquifer falls, it doesn't pencil. This means different covenants. Replace blanket production promises with stewardship covenants that trigger flex, not foreclosure. Write in water caps that move automatically with basin meters. If the cut hits, payments step down by formula and terms extend. The risk stays on the capital that chose the basin, not just the farm family in it. That's not charity, it's an honest spread for real risk. Portfolios have to slow down. Designed patient leases that trade a thinner dividend for thicker resilience. 7 to 10-year terms, rent bands pegged to field-level outcomes, and a floor low enough that a bad year doesn't turn into a liquidation. Add a regeneration rider. If soil organic matter climbs and water use efficiency improves, tenants earn credits against future rent or equity options in a local land trust. The upside is shared. The recovery is bankable. If you want to see behavior change, make transparency a signal, not a scold. Publish rent-to-yield ratios by county, anonymized but real. Show input footprints, nitrogen, water, kilowatt-hours per unit produced. List average lease terms and the share with shared risk clauses. Markets already price risk when they can see it. Give them visibility down to the variable that matters and watch capital migrate away from extraction. Funds that refuse to disclose will tell you what you need to know without a word. Repricing isn't theory, it's contract math. Imagine a stewardship lease on 1,000 irrigated acres. Base rent sits at a level that clears in a dry year without turning the tenant into a gambler. A performance band ties the rest to delivered volumes and quality, but only inside the basin's cap. Soil benchmarks, cover crop acreage, infiltration rates, organic matter, unlock credits that roll forward, cushioning future stress. A drought clause ties rent down and term out when allocations fall below a meter threshold. Every piece is auditable. Every incentive points at recovery, not extraction. For owners, this looks like a haircut at first. Then the system shows its logic. Reduced extraction lowers energy risk and lifts long-term yield stability. Longer terms cut turnover costs and vacancy risk. Soil that holds water buffers heat spikes. Water accounting reduces legal uncertainty. The return profile gets duller, which is another word for safer when you're funding pensions. You're not hedging with scarcity narratives. You're hedging with function. There's a cultural shift too. Treat agronomy as the balance sheet, not a footnote. Boards should hear from the people who walk fields, not just those who model them. Make annual meetings in a basin, not a ballroom. Tie a slice of management fees to verified stewardship metrics across time, not just assets under management. If the habit is to grow by buying, the counter habit is to earn by improving. Processors can move the needle. Offer premiums for documented regeneration, measured water savings, nitrogen efficiency, verified rotations, and lock them into multi-year contracts that justify patient leases. The margin is small in a spreadsheet. It's the difference between a tenant extracting to pay a ratchet and a tenant investing to earn a credit. Logistics follow contracts. Towns follow logistics. Cities have a role beyond cutting checks for transfers. Fund agricultural efficiency where your water originates with savings that stay on farm. Pay for recharge infrastructure that actually recharges. Build drought compacts with farm districts. When you lease water, you pay for cover and rest on the acres that give it up. If you want reliability, you help build it where the rain lands. Investors who want ESG don't need new acronyms. They need to accept slower compounding that lasts longer. A patient sleeve inside a large fund can target single-digit returns anchored in carrying capacity, long leases, soil and water benchmarks, transparent reporting, capped leverage. The upside is you don't wake up owning stranded assets when a basin cap arrives or a decade dries. The brand line is simple. We earn what the ground can give without emptying what it needs. This ends with a scoreboard the right people can read. Counties post meter data weekly. Funds publish rent-to-yield and water source mix quarterly. Leases record stewardship covenants on title. Appraisals show carrying capacity ranges, not comps that ignore caps. Underwriting letters model climate variance like it's weather, not fiction. If it sounds bureaucratic, it is. It's how you turn myth into math. Repricing reality doesn't punish land, it respects it. It takes the mystery out of what an acre is worth by tying value to what it can produce sustainably in a changing climate with finite water. When that number sets the rent, sets the loan, and sets the dividend, the season and the spreadsheet stop fighting. And when they stop fighting, grocery bills get boring again for the right reasons. The reveal, who's buying, why you didn't see them. We opened with a $10 trillion lie. Here, S who stood behind it the whole time. Start with pensions. Teachers, nurses, city workers, people who've never walked an irrigation ditch sit at the top of allocations that read agriculture real assets. Their committees approved steady, inflation-linked cash, and managers translated that into deeds. The pension doesn't wire money to a farm. It wires to a separate account that buys LLCs which hold parcels across 3 time zones. Every quarter, a calm line on a chart. On the ground, a rent letter. Insurers sit next to them. Premiums come in, claims go out, and the space between loves duration. A 10-year lease at escalators that beats CPI looks like a bond with dirt behind it. Insurers don't want excitement, they want predictability. Farmland leases became coupons. Irrigation pumps and school budgets became the counterparty. Sovereign wealth funds move quieter but heavier. The mandate is food and inflation hedges with water security where they can find it. A committee in a capital city half a world away signs North America agriculture mandate, and a manager in Chicago or Denver starts lining up platforms. Thousands of acres, export contracts, logistics within reach of a port, food security by proxy, water rights by deed. Then there's private equity and specialist ag funds. They pitch platforms and roll-ups, buy operators with scale and pipelines of deals, and impose a house style, standardized leases, escalators, tech requirements, and exit options, solar, logistics, water. They don't promise to farm forever. They promise to manage optionality. Returns first, duration second, agronomy third. Public REITs make the story visible without making it legible. You can buy a ticker that pays dividends from farm rent. You can read geographic diversification, tenant partnerships, and programmatic acquisitions in filings. You can't see the letter that raised a rent band in a drought year. You can't see the pivot motor that failed 2 weeks too soon. The beauty of the REIT model is that it looks like a utility. The risk is that it behaves like a story. Corporates own food processors, beverage companies, input giants, and retailers with captive supply ambitions. Sometimes they buy directly to lock in acreage. Sometimes they back funds that do it for them. The play is vertical. Tie fields to plants, secure water on paper, move product through logistics you influence. When a basin tightens, contracts win before neighbors do. High net worth investors round out the picture. Family offices and billionaires buy blocks for inflation hedges, legacy, and water. They show up in press headlines more than their share of the dough, but their habits matter. They can pay cash, wait out a season, and pivot to exits faster than a family with an operating note. Some become true stewards. Many keep their options open. Why you didn't see them is simpler than a mystery. Intermediaries did their job. Deeds list LLCs with names that sound like wind or grass. Those LLCs roll up to trusts. The trusts sit in funds with feeder vehicles offshore, Cayman, Luxembourg, built to solve tax and reporting needs. Property managers are the only voice tenants here. Custodial nominees sign filings. County records show agents, not beneficiaries. By design, distance. Data hid them further. Precision platforms branded as farmer tools became owner telemetry. Aggregated, anonymized numbers trained underwriting, which tenants deliver under stress, which parcels pump water into profit, which blocks convert well to solar, which rights move at a premium. The model replaced the relationship. The next rent decision arrived as policy. They also hid in plain sight behind narratives. ESG decks promised sustainable yield with positive impact. Water language stayed careful, resource secure, proximity to conveyance, priority rights, because explicit scarcity trading reads cold. Export ambition got called global demand alignment. Logistics conversions were highest and best use. Solar was renewable integration. Every phrase masked the same thing: crops when they cooperated, options when they didn't. Scale kept the camera wide. When a sovereign trims exposure or a pension rebalances, the move is footnoted as portfolio construction. Implementation lands as 4 parcels listed across 3 counties. Local prices adjust. A lender haircuts collateral. A co-op trims orders. Nobody writes, "This came from a boardroom on another continent." They write, "Market softened." And the beneficiaries, your grocery receipt ties back to their required return. A fund raising its distribution target doesn't email your supermarket. It lifts rent bands and tightens terms. Processors pay more to guarantee supply from operators who absorb the hit. Basis creeps. Freight spreads widen. The wobble shows up where you can't trace it. Milk, eggs, bread lifting a few cents when fuel climbs, then staying thereafter. So who's really buying America's farmland? Pensions searching for steady lines. insurers searching for duration, sovereigns searching for food security and water, REITs selling dividends, private equity selling optionality, corporates tightening supply, billionaires buying a hedge, a legacy, or a right. They didn't put their names on mailbox posts because they never needed to. They put them on LP agreements and dashboards. Here's the part that matters next. The same money that made leases shorter, rents tighter, exits faster, and water, a collateral layer, can move the other direction if incentives change. If returns are tied to carrying capacity instead of scarcity, if leases breathe with basins, if data flows back to the people who produce it, then pensions can fund boring groceries instead of brittle stories. That's not a slogan. That's a contract rewrite waiting on will. We opened with a $10 trillion lie. The truth is that food security now rides inside vehicles you can't see, governed by rules you were never asked to sign. The fix isn't outrage at a list of names. It's forcing those names to earn their quiet by aligning with the ground they own. The next map shows the water and the wires that make that possible. What this really means, what you do next. The decision to treat farms as stable tickers turned dinner into a line item. Stability doesn't grow from spreadsheets, it grows from seasons that have limits. If you want the map that exposes who holds the water and where the pipelines run, watch the next chapter. Subscribe so you don't miss the owner webs, the basin caps, and the pressure points your town can pull. The story only changes if we see it fast enough to rewrite the contracts.